about building a trading plan. Now, too many traders come to the markets and think, oh, they're going to use this indicator, this oscillator, this system. They've got this app that's going to tell them what to trade. They get these signals. They're going to just go out there and trade. Well, most of those guys go home down the road with their tail between their legs, mad at their broker because they've lost all their money. Well, trading's got very little to do with strategies, indicators, oscillators. Trading's all about finding high probability of success trades, building a successful trading plan, keeping your emotions out of the market, learning how to understand your risk tolerance, your money management, and how to properly enter and exit a trade. Okay, finding trades is the least important part of the whole deal because there are thousands of trades every day. There's always an asset available to be traded. There's always a market making a move. So you can always find something to trade if you want to trade it enough. But in order to become a successful trader, you need to develop a written trading plan. Okay, yes. And you're saying this guy's a moron, aren't you? But yes, you have to develop a written trading plan. Because face it, if you were opening a business and you were taking all your hard-earned money and your retirement funds to open this restaurant or to open this retail store, would you do it without a plan? If you're going to open a restaurant, aren't you going to decide what hours you should be open? How many turns you need to have per table? How many menu items you need to have? How many refrigerators you need to have? What days of the week you should be ordering what quantities of what vegetables? Or you just can do it by the seat of your pants and hope that you have enough stuff to cover the people coming in the restaurant, and you're not throwing away too much chicken at the end of the week because you ordered way too much. Or you may find out that your customers don't eat hamburgers. They might prefer sandwiches. Okay? Without a trading plan and out of way and analyze it without understanding what your business is doing, before you know it, your business is going to close. Okay? How do you know how much staff you have to hire? How many hours they should be working? When should you have the bartender come in? When should you have them go home? Part of your trading plan. Now, there aren't any specific rules about a trading plan. They're your guide. They're personalized. They cover every aspect of your trading, but it's different depending on who you are. And they don't have to be very complicated to start out. You keep adding to them. But you're not going to be able to go to the bank and get a loan to open up your restaurant or borrow money for your equipment without some type of a plan. Well, if you're asking your brokers for leverage and you want to put $1,000 in and trade $100,000, don't you think you should have a plan? And a trading plan can be thought of as a template for trading the markets, perhaps just a checklist. Okay. It should include what your trading strategies or what trading strategies you will be using, what assets you will trade, what your daily routine will be. So the question is, where do I start? Well, it's no different than if you're opening a business and you need to borrow $50,000 from the bank. And the bank says, oh, please bring us your business plan and we'll take a look at it. Well, I've seen business plans that are hundreds of pages long with spreadsheets and all types of market evaluation. And I've seen some that are 4 pages long with a couple, possible scenarios. You don't have to build this masterpiece to start out. You can build a summary. You can add a general plan of what you expect. You can project some figures based on what your knowledge is, and then build it and add on to it as you get closer to the opening date, as you get more information, as you've gotten more things to find. So the question is, where do I start? Because it can be a daunting process. Well, the fact is, most of us have some type of a trading strategy in the back of our minds that we're going to use when we start out. We'll start that. Put that first thing into your trading plan and write it out. Not when Barry sends me a signal to trade, I'm going to go spend my money on the euro US dollar. Like, that's not a trading plan. It's not a strategy. And then add on to it. You should incorporate all of your money management rules. How much you're willing to invest per trade, how much your risk tolerance should be, how much money should you have in the market at any time. But having written strategies with your risk tolerance and money management is like having a market blueprint. This blueprint is essential to developing the discipline that will lead you to the road to success. Because trading, like I said earlier, isn't about finding the strategy. Okay? It's not about finding a trade. It's about making the best trade possible, putting your emotions on the table, having a plan. The first thing you should incorporate in your plan is what assets are you willing to look at? Because today with online trading and computerized charts, what I come across is too many traders trading too many assets. When I started this market 40 years ago, I was an agricultural trader. I only traded agricultural futures. And I primarily traded orange juice and coffee. That was it. For 20 years, I traded basically two assets. Then you need to have some type of a routine for your trading activities. What will be your pre-market phase? Okay. Pre-market is what you do from the time you wake up and start with the markets. Now, it doesn't have to be a full-time job, a part-time job. You could be a student, you could be a retired person. But too many traders go to the Avexo platform, and before you know it, 15 minutes later, they're making a trade. That's not what you do. First, you start out, okay, you decide what you're going to go through the assets you trade and take a look at the charts. You're going to look at the economics calendar. You look at the financial headlines. You're going to try to decipher what happened in the market for the last 12 hours by looking at your charts and seeing them. You're trying to try to find some of the assets that might be trending up or down that might offer trading opportunities. Okay. This is your pre-market phase. You're not ready to make a trade. You're not ready to do anything. All of us, all we want to do is trade. And unfortunately, that's it. We want to trade. I mean, I've seen some traders enter more trades in one day than I trade in a whole year. Then we have our post-market phase. And see, if you write this in your trading plan, this is what goes in your trading plan. Okay, when I turn on my computer and get ready to sit down and think about my trading time, I'm going to go to the economics calendar first. From there, I'm going to go to the charts. From there, I'm going to do this and do that. Not, I'm going to go make a trade. Your post-market phase is how much time each day or each week you're going to spend analyzing everything you did. Because you need to keep records of every one of your trades. You need to analyze your trades. Because sometimes the strategy is working, but not working well enough, and you haven't fine-tuned it. You don't realize it's going out of phase. And before you know it, you've made too many losing trades because you didn't analyze your trades and you didn't realize that this strategy isn't working right now. Because markets change. Strategies that work great for a month may be horrible this month because the market changes, the attitude changes. So whether you trade RSI, Bollinger Band, Stochastics, whether you're using an app on your cell phone, some auto trader, okay, they could do great for 2 weeks and then be terrible for the next week. Not because they're bad, markets change. So you want to make sure you maintain a trading journal, which is a log of all your trades. Now, I've given you in some handouts tonight, I believe I have. Let me just check. I believe you have some handouts tonight, right? Hold on a second, there we go. Yes, I've given you some handouts tonight. Now, these are different sample trading plans. They can be complex, they can be short, because there is no rule of thumb. There isn't a written one that I can give you and say, follow this. But the fact is, excuse me, if you're an athlete, you're a soccer player at the World Cup, you just don't get up this morning, get out on the field and start kicking the ball. You have your training, you have your sessions with the coach, you have your planning, you have your team meetings, you have all of this. You evaluate every play, you evaluate the other players, you evaluate who you're playing against today, what plays may work, what strategies might work, the injury list, who's going to be doing what. Okay. So if an athlete has to do that, what makes you different? You need to put this effort in. And believe me, they have playbooks, they have guidebooks, they have rule books, they have everything. You need the same thing. Now, sure, you can go hire a coach for a couple $100,000 that might write it up for you based on who you are. But your trading plan should contain a written description of what you would do in the markets. This includes things like your trading edge, how to trade it, when you would trade it, what time frames you would trade, your strategy for risk management and for profit taking, and your overall goals as a trader. I use the word stick to it. It's not really a word, but the creation of a trading plan is highly useful as it reduces the possibility of a bad or irrational decision based on emotion. If you have a written trading plan, then you have a trading filter that will filter only high probability trading opportunities. It'll get rid of all the other garbage for you. The key to disciplined and objective trading is to establish a trading plan where you put all the necessary rules into it and stick to it. So if I ask 100 traders to send me a copy of their trading plan, I guarantee you not one of them has anything to send me. I don't think I've ever, in all the years I've been teaching, ever had a student present to me actually a trading plan. I've had some notes, I've had some Excel spreadsheets, but I've never seen anybody with a developed trading plan. Now, it doesn't matter today, but you have Excel, you have all the computerized skills. You don't have to do it by hand. But just think, you can sort everything with Excel. You can do whatever you want. Come to my house, I have boxes and boxes of file cards. I have sticky notes all over everything. Okay. I have steps and processes and procedures that are, each week I print out the sheet that I follow and I make sure there's a checklist. And because like I said, if I make 10 trades, it's a lot in a whole week. So I can print out this little list and check off the things I want, because as I go through them and get them ready, I keep on going till my list is ready, and then I'm ready to make a trade. Now, every business, no matter what you're in business doing, has a way to evaluate your performance. Like I said, how does a restaurant know they're not throwing away too much chicken, or they don't have too much staff sitting around doing nothing? Okay. Or if you have a clothing store, how do you know how many smalls, mediums, and larges to buy? How do you know what's selling better, pink or yellow? So you start out with a base evaluation period, and you keep evaluating and keep evaluating and keep defining it. Because really, in the world of trading, time's irrelevant. Fact is, you're not like a restaurant or a store where stuff is going bad. You have customers. Fact is, the markets are open virtually 24/7. There's always trading opportunities, and if you miss a trade today, there's always a trade tomorrow. So at what point will you stop everything you're doing and evaluate your performance? And that's really important. It's one of your key things on your trades. Now, for me, the number's 10 trades. Now, this is only me. Depending on how many trades you make, how new you are, how careful you are. Okay. So on the average, it'll take me approximately 3 months to place 10 swing trades, or about 4 days to place 10 day trades. That's it. So I only mentioned time elements so that you can see how long it takes me to place that number of trade. And then once I've finished my 10 trades, I sit down and I analyze every trade. I write it up. I make sure it's in my journal. I make sure all my notes are on it. Everything is done. And I evaluate my performance, and then I move forward. Because if you get yourself hooked on trading, it's like going to the racetrack. If you're only guy there and all you want to do is stand in line at the windows betting, Or you're the guy who's sitting there looking in the paddock, looking at the weather, looking at the track, looking at the horses. And sure, the ultimate result comes from placing a bet and winning. But doesn't that result come more and make you feel better when you've done all the analysis and you've done everything right and you just figured out that your system, your strategy works really well? So what is the number of trades you'll be using when you evaluate your trading activity? And then what factors will you be evaluating? Because just profit and loss isn't enough. But you can make it simple. You don't have to overcomplicate it. Just make sure you're evaluating your trades and understanding what you're looking at. Okay. Then, what time of day will you trade? That doesn't make a difference. You know, if you're a retired person and you have time at 11 o'clock in the day, fine. If you've got a full-time job or you're a student, it doesn't matter. But the markets have different personalities. And you have different personality. So for me, I trade from 9:50 in the morning till 12 o'clock. That's it. If I don't have any trades or whatever trades I have at 12 o'clock, I'm done for the day. My trades may be still running. I'm not closing out my trades. But since I get up at 5:30, by 9 o'clock, I've already done all my evaluation. I've already done everything. Everything's going. And basically after 12 o'clock, if I want to go out and have lunch, I want to have meetings, I want to go see a client, I could do all of that because I have my stop losses in place anyway. Otherwise, the rest of the day, I'm a speculator on the sidelines. I can watch the markets, learn. Because if you get your enjoyment from this, not from trading, if you get your enjoyment from watching the markets and understanding them, you'll be good. So similar to times in trade, you want to figure out what you're trading at. Too many traders use too many complicated charts, too many things to predict the market. Simplify something. I want to trade from trend lines of support and resistance. Okay, I want to trade from chart patterns. I only want to trade when RSI is over 70, whatever you choose, but make it simple. Combine it with volume. I only want to trade when volume's high. Okay, I only want to trade when there's a breakout from a pattern. Whatever you want to do, but make it simple. Because I've seen charts that have a million technical indicators, a billion things on, and guess what? They've all derived the same thing I've derived. I'm going to trade that asset to go up. They're not any better than a simple one. They're just more complex. But guess what? It doesn't get you more high probability success trades. So define your edge and follow it. Then develop a methodology for identifying plays. So mine is, and my recommendation everywhere is, always look for an asset that is trending either up or down. For day traders, you will focus on the market movers because this provides you the greatest opportunity for locating an asset that is trending hard with high liquidity. And if you're only watching a certain number of assets, I'm looking no more ever than 20 assets. I can look real fast. There's always gonna be something that's trending. Okay? When I see the ones that are trending, some days there aren't. Some days the markets are just moving sideways. But so what? I don't trade today. I don't care. So figure out your goal and a plan. Figure out what strategy. Then you can incorporate with strategy. Whatever strategy you want is what you want. That's part of your training plan, but it's completely up to you. It's personal. But I'm a hardcore believer in support and resistance. And I will only make a trade, no matter what I'm using, when it's broken a support or resistance line or above and below support. Then you want to figure out your stop losses. Now, stop losses are ultimately important because it limits your risk, but it also keeps you from making a trade you can't afford to make. Because if you figure you can only risk $200 per trade, in order to not exceed that risk, you've got to put your stop loss too close to the price, then guess what? You don't make that trade. If you also figure you're only going to make trades that have a minimum of 3-to-1 win to lose ratio, and I'm willing to lose $200, I got to be sure that that asset has a target of $600. Okay. If it doesn't, I'm not going to make that trade. So, and then When you figure out where your stop loss has to be, then you have to go back and look at the market volatility. And is the market swinging below where your stop loss would be? Because you don't want to just place a trade to get stopped out all the time. You also have to include when you'll exit a trade. You've heard that all market wizards say, let winners run. Well, the fact is, you get too involved with greed. I set a target price. Now, I have many different targets. And at certain targets, I'll move my stop loss off. Some targets, I'll sell half my investment, depending on what I'm trading and how I'm trading. But you have to have your exit strategy, your lock-in strategy. And you want to keep it simple. But you can just say, whenever RSI goes into overbought, over 70, I'm going to close my position. I'm going to take the profit I made. Okay. You just have to have something and write it down. For some reason, traders have fooled themselves into thinking that successful trading only boils down to the latest algorithm or technical indicator. This couldn't be farther thing from the truth. When you're trading, you may forget there's human beings on the other end of a buy and sell transaction. It's a fight between the bulls and the bears. While everyone may have stop loss orders, technical indicators, charts, access to news, etc., there are some traders who are able to translate all this information into successful trading or profit. The success factor, my friend, begins and ends with a winning attitude and begins and ends with having a structured trading plan. Winning traders will see the same price movement as you. However, they will not interpret the information negatively. They will see a slight pullback in an uptrend as a healthy price action and will comfortably watch the chart move without a negative emotion in their body. Their ability to sit through these corrections does not mean they have a lack of money management principles. It just means they believe the markets will go in their favor as long as the correction or counter moves do not damage the overall trend. And by having your rules in place and your stop loss and your take profits, you won't panic sell. And then a key part of your trading plan is how much money not only will you make per trade, but how much money will you have in the markets at any given time? You know, there's an old rule of thumb that you should never invest more than 8% of your capital in any one trade. But there's not a rule of thumb of how much money you have in the market. So you could have 8 or 10 trades going on, each having 8% of your capital. And before you know it, you have most of your capital tied up in the markets. The markets, you know, Donald Trump does something crazy or North Korea does something crazy. So all of a sudden the markets freeze and the markets turn against you because it goes into, you know, some type of, you know, risk scenario. You could, you know, get killed. So not only how much can you risk a trade, but how much you can have in the market at any given point. And this should be written down. Then rule number 9, you'll think I'm crazy. It's when to take a break. Now, I take a break after I've completed 100 trades. So if I do 10 trades in about 4 days, in a couple months, I've made 100 trades. I shut for that. Once I reach 100 trades, I shut down my computer and I go away. I take a couple days off, or at least a whole day. Not a Monday holiday, not a bank holiday. I take a day away from the markets. A holiday doesn't mean I'm not going to work. It means I'm not even looking at the markets. And this has nothing to do with the markets. It has to do with you. It puts you back in control. It reinforces your discipline and reinforces your control of yourself. Because at that 100 trades ends, you say, okay, I'm following my rules, I'm following my plan, and you get back into sync. Because while the markets are always there, it doesn't mean you have to respond to their every move. And then, all important is when to take a break and keep calm. For me, if I lose 2% of my trading capital at any point in the day, if I've got 6 trades going on and I'm down 2% of my trading capital, I exit all my positions and go fishing for the day. Because for some reason, the market gods are not shining in my favor. On the other hand, I can have a day, and if I made 7.5% of my trading portfolio on one day, I shut everything down and go fishing. Because you know what? I say, somebody smiled on me today. I'm taking advantage, saying thank you very much. And I go away. Because again, it exercises control. And when you've had a very good day and you've made a lot of money, you don't want to throw it back into the markets. When you've had a very bad day, some days the markets just turn against you. And you can get locked into a very bad cycle. So shut it down. And if you have it written down as part of your trading plan, you'll tend to follow them. So remember, you want to make a simple trading plan, just a starting point. When you write it down and you leave your emotions fine, keep defining your plan. It doesn't happen overnight. So like I said, I've given you 3 examples in your handouts. They're only a point for you to get started, but it's important. It's important to teach yourself and discipline yourself that it's not about trading. It's about the time of building your plan, about time of analyzing the markets, the time of initializing self-control, the time of understanding risk management, money management, because trading is very little to do about strategy. It really is. When you understand the different types of orders, limit orders, market orders, OCO orders, you understand stop losses, you know, and you always place them because they're part of your plan. And you always exercise proper money management, risk management, and you properly analyze all of your trades. You'll find that you are the one in control. You're the one who's controlling the markets. The markets aren't controlling you. And you'll find that when you do that and you leave your emotion behind, you will start becoming a successful trader. So on that note, I'm going to say goodnight to everybody. Sorry for my voice. For some reason, I'm losing it. This is my 4th class today, so I guess it's just too much talking. But enjoy the handouts. Thank you very much. And if you have any questions, go to www.alvexo.com and use their education platform. And they have a whole bunch of videos and ebooks on building a trading plan. And also, their customer support will hook you up with a financial analyst. So be glad to explain it to you or help you work your way through one. So thank you very much. Thank you for supporting Alvexo, and have a great trading night. Good night now.